Our current agenda looks at financial policies in the Financial Stability Board, the International Monetary Fund, and international tax policy. And we try to look from the perspective of those excluded from the room. Those in the room at the table are able to speak for themselves, but our agenda is how do we get, especially the low-income country, voices, perspectives, and the consequences of the decisions taken by the Financial Stability Board, IMF, and basically OECD taxes. How do we get the low-income countries in the room and the consequences considered? So this is one reason we have met a few times with Governor Tarullo and with other U.S. Delegates to the Financial Stability Board. We also work with civil society on issues relevant to the Financial Stability Board. And after a series of meetings, we identified 6 issues. One is the Financial Stability Board governance, per se. And then there are 2 issues the FSB does not deal with yet, and we think they should if they are concerned about global financial stability. And that is, number 1, sovereign indebtedness. Number 2, tax regulation. Everything from illicit financial flow. If you want to stop financial instability, then you have to look at the tax havens, the illicit financial flows, because they're huge, and what are you doing about it? And then 3 issues that are relevant to campaigners as well as low-income countries are banking policies, especially cross-border bank resolutions, derivatives as a tool for speculation, especially in food and fuel, and Nathan, what's the other one?
Which one did you say?
Derivatives, banks, and trade and financial services, which Lori Wallach will speak about. Lori is a trade attorney who has been very involved in international financial services. And we look, for example, at the inconsistency of U.S. policy. When you look at the position of the U.S. government in the WTO compared with what we have agreed to in the IMF and the FSB, and then in the very narrow, restrictive bilateral trade agreements and regional trade agreements. So those are some of the areas we work with. We do a lot of work with people. We don't do it all. We work with people. We come from a coalition, and we maintain a coalition mentality. So with that, while we wait for the last board member, if we might do an introduction of people sitting at the table. I'll start. I'm Jo Marie Griesgraber. I'm the Executive Director of New Rules for Global Finance.
I'm Michael Taylor, a member of the Secretariat of the Financial Stability Board.
Grant Spencer, Deputy Governor of the Reserve Bank of New Zealand.
Maher Hassan, Deputy Governor, Central Bank of Jordan.
Eric Gorowski, former Executive Director here at the bank, and now fighting against cost regulations.
Patrick Flanagan from the World Bank Group.
Pierre Chatin, World Bank Group.
Karen Joyner, I work as a consultant for CSOs.
At the back row, please.
Marjorie Enriquez for the IMF. Easton Yamago with New Rules for Global Finance.
Jeju Nita and New Rules.
Nick Leclerc, the World Bank.
Thank you.
From the Central Bank of Turkey.
Özge Ülgen, Central Bank of Turkey.
José Estrada, professor at the University of Montevideo, Uruguay.
Oh, bienvenido.
Thank you.
Placer.
Thank you very much.
Prana Singha, IMA.
Swarna from Central Bank of Sri Lanka.
Rosemary Seguero, President of Segueros International Group. I'm starting my capital venture fund.
Great.
Alberto Orsi, from Institute of International Finance.
Abhijit Levad Kabra, Governor of the Central Bank of Sri Lanka.
Trollhättan, Deputy Governor from the Central Bank of Turkey.
We're doing self-introductions, sir.
Joseph Joy from Wellesley College.
Thank you. Okay, with that, we've had the introduction to new rules, and now what I'd like to invite is Michael Taylor to talk about the nature and structure of the Financial Stability Board for those who may not be informed and for those who subsequently watch this video. And then we have 2 issues we would like to have a conversation about, and that is the way that Financial Stability Board regulations do or do not affect the lives, the countries that especially are non-members. And the gentleman from Turkey is the truth teller from inside the Financial Stability Board. And also about the governance of the FSB. Whether it's inside, because the major countries have 3 representatives and the smaller countries have 2 or 1. And also the regional consultative groups, how they function, are they effective, what goes on inside. This is really an effort on our part to figure out what is going on inside those regional consultative groups. So, Michael, if you would be so kind as to describe the FSB in general, and then you'll be our technical assistant.
Okay, well, thank you, Jean-Marie, and I'd like to thank New Rules for giving me an opportunity to speak to you this morning and an opportunity to explain a little bit more about what the FSB is and what we do. Can you hear me at the back? I'm conscious that we don't have voice amplification here, so it's. I just want to make sure I can be heard at the back there. Yes? Okay, good. The Financial Stability Board was established in 2009 following the global financial crisis, and it was the successor organization to the Financial Stability Forum, which itself had been set up in 1999 in the wake of the Asian financial crisis. The Financial Stability Board is a body of the G20, but we include also, in addition, a number of other countries which are not G20 members, but which have significant financial systems such as Switzerland and Singapore. So our coverage is certainly not universal. We don't have the same kind of almost universal membership that the IMF or the World Bank have. But what we aim to do is to cover a significant part of the global financial system, and our membership comprises or represents about 85% of global GDP. So it's significant. Now, the Financial Stability Board was established with a threefold mandate. The first part of our mandate is the assessment of global financial vulnerabilities. The second is to develop policies for global financial stability. And the third is to oversee the implementation of international financial standards. Now let me talk about each of those in turn and how they fit together. The assessment of vulnerabilities is a key part of our work. It's conducted in conjunction with the IMF. It results in several outcomes. One of them is an early warning exercise, which is conducted semi-annually. The second is an assessment of vulnerabilities, which is presented to our plenary when it meets. Now, the object of this exercise is not to duplicate something like the IMF's Global Financial Stability Report, which I'm sure many of you are familiar with. We're not doing that kind of in-depth analytical work. What it is an attempt to identify a number of emerging issues which we think policymakers need to focus on, and to provide the basis for a structured dialogue among policymakers in terms of what are the emerging vulnerabilities in the global financial system. One of the ways in which that then connects with the policy-making function of the FSB is if the judgment is that some of these emerging vulnerabilities require some sort of policy response, then this is passed to the second part of our role, which is the Standing Committee on Supervision. So I should step back a moment and just explain that as part of this threefold mandate, we have three standing committees. The Standing Committee on the Assessment of Vulnerabilities, or SCAV, the Standing Committee on Supervisory Regulation, which SRC, and then the Standing Committee on Standards Implementation, SCSI, SCSI as it's known, a rather unpleasant.
They have more acronyms than you can believe.
Well,
Good luck reading their papers. You absolutely must have a list of acronyms.
It took me about
Congratulations, you've won a prize on the most inscrutable acronyms for any organization.
It did take me about a year to work it all out after I arrived in the Secretariat. So we have these 3 standing committees, and then over and above those, there's a steering committee and then a plenary. And the plenary is the meeting of the principals of the FSB. The standing committee is a smaller body which meets between the meetings of the plenary. The plenary meets 2 or 3 times a year. And then the standing committees meet on a slightly more regular basis. So if the assessment of vulnerabilities in the global financial system requires, or is thought to require, some sort of policy response, that is then passed to the SRC to develop a policy response. And the final part in the jigsaw is the standards implementation part of it. Now, this was developed to fill what was obviously an important gap in the global standard setting framework. In the pre-crisis, you had a number of standard setting bodies, such as the Basel Committee on Banking Supervision, IOSCO, the International Organization of Securities Commissions, the International Association of Insurance Supervisors, and so on. And each of them would develop their standards, and they would do so more or less independently of each other. And one important role of the FSB, which is carried out through SRC, is the role of ensuring that the standard setting bodies adopt a coordinated approach. So there may be some issues which cut across the responsibilities of some of the standard setting bodies, and our role is then to coordinate. There may be some issues that come up which are not obviously the responsibility of any of the standard setting bodies, and there our role is to develop our own principles and standards. So, for example, on compensation practices, there is a standard which is an FSB standard. It's not a Basel Committee standard, it's not an IOSCO standard, but it's a standard that we've developed ourselves. And similarly, as far as resolution is concerned, again, we have the key attributes, which is an FSB document. It hasn't been developed by the other standard setting bodies. So we coordinate where possible, and where necessary, where there is a gap in terms of the responsibilities of the existing standard setting bodies, we will supplement their work with principles of our own. And then the third stage is the implementation of the standards, and the implementation of the standards is something we have a monitoring process which delegates the monitoring to the standard setting body, where it has in place a monitoring framework of its own. And some of you may be familiar with recent work that the Basel Committee has done, for example, in terms of monitoring progress on the implementation of Basel III. So the Basel Committee has a monitoring process in place, and the FSB essentially delegates or defers that task of monitoring those standards to the Basel Committee. But again, we provide some kind of overarching coordinating function. And then finally, again, there are a number of areas where the FSB itself can get directly involved. We have a process known as the peer review process, which has a double dimension to it. One is to conduct peer reviews of our individual member countries. This process builds on the work that the World Bank and IMF do in terms of their financial sector assessment programs. It supplements that. It looks at some of the recommendations that have come out of the financial sector assessments that have been conducted of our member countries, and then we'll look at follow-up on the implementation of some of those recommendations. Or alternatively, the peer review can be a thematic peer review, and it can look cross-country across our membership in terms of the progress being made on the implementation of particular standards. Again, you may have seen quite recently we issued a peer review on resolution, looking at the progress that had been made in terms of adoption of the key attributes. Prior to that, we've done thematic peer reviews on risk governance and on deposit insurance. So we can perform a useful monitoring role in terms of ensuring that our members live up to the commitments that they've given, which is to implement the key international standards and to have a review, a regular review under the FSAP process. So that essentially describes the threefold mandate of the FSB. Essentially what we're there to do is to fill some of the most obvious gaps that were identified post-crisis. And those gaps were in terms of the assessment of vulnerabilities in the global financial system, providing a forum for a structured dialogue among the key players in terms of what are the key emerging vulnerabilities, providing a mechanism for enhanced cooperation in terms of the development of supervisory and regulatory policies, and then thirdly, the standards implementation. Now, obviously, as I said at the beginning, our membership represents about 85% of global GDP. But then that leaves 15% of global GDP which is not represented. And there are obviously some countries which have a significant stake in terms of the output of the international standard setting process and wish to be involved in that process. And to that end, we, a few years ago, 2 years ago, established the regional consultative groups, which Jo Marie mentioned in her introductory remarks. Now, the objective of the RCGs is to provide there I go again, acronyms again, RCG Regional Consultative Group.
There will be a quiz before you leave. No one leaves the room until you can pass your acronym quiz.
The RCGs have in total about 65 members now. They are divided into 6 main geographical areas. So we have an RCG for Europe, for the Americas, for the CIS, for Asia Pacific, for Africa, and for the Middle East. Have I missed one?
Latin America?
Latin Americas. The Americas is both Latin America and...
Okay.
Anyway, the RCGs provide a mechanism whereby the FSB membership and non-members can have, again, an informed, structured dialogue about current developments, current policy developments, again, discussion of emerging vulnerabilities and what the appropriate policy response would be, and to encourage a two-way dialogue between the FSB members and non-members. It's still in its early days, and I'm probably not the best person to talk about that. I think the Deputy Governor from Turkey was probably better placed to speak about that. The members the chair of the RCGs comprise a member and a non-member. So, for example, with the RCG for Middle East and North Africa, we have Turkey as one of the chairs, and then but the chairs rotate, so there will be a rotation of chairs every few years, as there has just been with the standing committees. The standing committees are, the chairs for the standing committees have recently changed. There is an intention for a 3-year rotation of those chairs. Recently, Augustine Carstens from the Bank of Mexico took over as the chair of the Standing Committee on Vulnerabilities. We have, as chair of the Standing Committee on Regulation, Regulatory Cooperation, Dan Torello from the Fed, and the chair of the Standing Committee on Standards Implementation is Ravi Menon from the Monetary Authority of Singapore. And before them, the chairs of the committees were
That's okay.
So it's okay. The jet lag is hitting me, I'm sorry. So before that, we did have chairs of the three standing committees, which have just changed. So I think that basically summarises the main points of the FSB. I think rather than take up more of your time, I think it's good to open up to a dialogue.
That's great. Thank you so much, Michael. By the way, we want to know, what about the non-members? These are the people that we worry about. You've got the, anyhow, and just for since I'm chairing, I get to put in my own agendas once in a while. I think that some of the vulnerabilities you're missing are the sovereign indebtedness, that there's no organized, systematic way to deal with indebted sovereigns. Every time we muck around and don't know what we're doing. I come from the history of third world debt and the Jubilee campaign, so I do know debt. And the other one is illicit financial flows and its linkage to tax havens and the tax issues. So after that commercial, if I might invite, if anyone of the four panelists would like to start about your experience with these regulations, with the regional consultative groups, or anything you'd like to bring of your experience or your questions about the FSB. Go for it.
Just briefly.
The chair recognizes the gentleman from New Zealand.
Yeah. So we're a small country, not a member of FSB, not a member of the Basel Committee. So, but we are a member of the RCG for Asia, and that's a useful vehicle for us. I think it's a good initiative. As Michael said, there's two-way flow of information. And so we find those meetings useful for receiving info about what's happening in the FSB, as well as giving our perspective. Now, we're never quite sure, you know, the two-way information, never quite sure what impact the other direction of information has. But, you know, we get the feeling that people are listening, and overall, if there's a common theme from the smaller countries, my feeling is that you know, can have an impact. But I would say, in terms of the sort of challenges, the challenge for me from the FSB, from a small country perspective, is achieving this cooperation and consistency in standards that amongst the major countries, amongst the FSB member countries, that avoids regulatory arbitrage, you know, achieves that standard of consistency, but allows enough flexibility for small countries. Because there's so many of these issues where the complexity required at the FSB level is not really suited to a small country. And so we've found that it varies across issues. There are some issues and some sets of standards that come out of the FSB that are very useful for us, and there are some where we find, well, this is not really, you know, we don't fit into this regime. And I'd say, just as a couple of examples, one of the more positive ones for us is resolution, the resolution principles, because we've been developing particular sort of bail-in type resolution regime, and the FSB principles and the sort of umbrella approach we found is really useful for sort of pushing that through and selling it. An example of sort of on the other side where we probably feel that we're sort of being dragged along, probably, you know, in potentially unproductive ways around the derivatives reform and central clearing of over-the-counter transactions, where for a small country which was operating quite efficiently on an over-the-counter basis, it's really this global development now is causing our financial institutions to have to change the way they do things, and it may be positive, but there are some inefficiencies as well. So I won't go into that in any depth, but there are examples like that where there's some things that are quite positive for us, some less so.
Thank you.
But that's just a couple of observations.
That's very, very useful. Okay, who would, among the three gentlemen here, who would like to go next? The chair recognizes the gentleman from Sri Lanka. This is the way the Congress does it. The chair recognizes the gentle lady from Minnesota. Okay.
Thank you
please.
for the recognition, Chair. We also are members of the Asia Pacific RCG, and I've found that the interaction that we've had in that has been very effective. There has been a fair amount of exchange of views, and that has been useful in order for us to understand what's taking place at the G20 level. And at the same time, it has been a useful exercise for us to escalate some of the views across through the chairs of the RCG. So I think so far the experiences have been favorable, and I would like to see that continuing because that will have a lot of merit. At the same time, there were a few areas that I thought which have been highlighted in the notes that you sent, particularly the area about the derivatives. I think it's essential that a greater awareness be created worldwide about the various nuances of derivatives, because we read so often about mis-selling and various complications that have arisen in so many regimes as a result of derivatives. While it may be having its useful areas for many countries as well as organizations, it also has its other side, which needs to be addressed quite seriously. Perhaps some basis of punishment for institutions that regularly are found wanting in the implementation of derivatives may be a useful course of action, and that's something that might be worthwhile looking at further. The other point that was mentioned in the notes that we received was about banking regulations. Now, we all realize that setting banking regulations is much easier than implementing banking regulations, because implementation requires fairly wide knowledge, very good technical skills, and also a set of people who can understand banking in its real sense. Now, that's something that very often is neglected, and maybe an area of vulnerability which we need to address as time goes on. And I think Deputy Governor Spencer's point about the regulatory arbitrage that can arise is also an important factor here, because if there are regimes or economies within a particular region which have asymmetrical banking regulations as well as implementation, it can very often lead to various institutions using that to arbitrage in their own operations. So that's one area that we need to really look at. The other point is about the macroprudential policies, which now are increasingly used by many regulators, not only for purposes of trade and commerce, but also for monetary policy. And it is a healthy development in my view. But at the same time, there is a fair amount of blurring as to where one starts and where the other ends. And perhaps we don't need to go through so much to decide which bucket it falls into. But at the same time, we must need to recognize that these are useful tools for regulators to be focusing on as time goes on in order to ensure that stability is maintained. We must also recognize that some of the policies that are being introduced now and are being implemented, policies like quantitative easing and credit growth, which is quite strong all over the world, possible creation of bubbles, can also mean that we need to examine the vulnerability that could be caused by those policies in the future. Perhaps in that sense, if we were to implement certain counter policies in a gentle fashion earlier, so that we don't really are not taken by surprise, and we are able to ensure that there are some soft landings when these policies are to be reversed, may be useful, and we need to look at that as well.
Do you want to give an example of a counter policy?
Yes, for example, now, particularly with regard to asset bubbles that can be formed with a huge amount of liquidity that is being created, perhaps some internal policies of governments as well as regulatory authorities to ensure that there are some new risk-weighted assets are being created within the organizations of the regulators, which will ensure that the growth is not very fast, that the growth is controlled. That would ensure that when the reversal occurs, that it's not going to be very, very difficult.
Thank you.
Two final points. One is there's no shortcut to ensuring that vulnerabilities are controlled, and you need to build buffers in difficult times, and I think that's where regulators need to focus on, ensuring that sufficient buffers are being created all the time, so that all over the world. But at the same time, we also need to recognize that in time to come, there will be new institutions that will fall into this category. The global economy, whatever happens, will grow in the future as well. That would mean that there will be new institutions that will come into this category. So at least if those institutions, when they are in the progress of coming into these categories, if they have certain boundary lines set out, then that will give us a bit of a handle, better handle than what we have now, to ensure that those will be not subject to the same vulnerabilities that the present members in the club are subjected to. So perhaps the entry of new members into the club of too big to fail, we need to ensure that they are given some guidelines and there is some overall boundaries that are set out so that they will be less vulnerable than the existing ones.
Thank you. Thank you very much. The chair recognizes the gentleman from Jordan.
Thank you very much for inviting me to this I'm from the regional committee that is now chaired by Turkey and Lebanon in the MENA region. Can I just explain?
The little teeny black thing is a mic.
This is the mic.
You don't know, it doesn't look like a mic, but it is.
And I actually participated in just one meeting that took place, I think, last month in Riyadh. I found the participation give you a chance to have discussion about the development at the FSB level. Some of these development or discussions are quite relevant to our region. One of them, for example, the macroprudential policy framework, which is something that has been implemented for several years in many countries without calling it macroprudential. And then when the discussion came about the governance of taking decision when it comes to macroprudential, what are the side effects, what are the possible tools, and how different countries deal with different sort of risk. I think I found that quite useful sort of discussion. I share the views that I'm not sure from a small country like Jordan or specific region how our experience or the challenges we face in our financial system will be quite relevant to the FSB. If we are talking about 85% of the financial system globally, by definition, what happened in a small country would not be quite relevant to the agenda or to the reform agenda in general. Now, thinking more generally about the work of the FSB, there are, in addition to this positive element of this dialogue and sharing knowledge about where the global reform agenda is heading and how we can benefit from it in Jordan, for example, there are still quite significant issue, at least from our perspective, that we would like to see the FSB handle, and also we have questioned why it's handled in a specific way. Let me give one example. the reform related to the compensation. We think it's quite important because at the end of the day, it's the incentive structure that exists at the managerial level or the CEOs and the board who decide to large extent the way they're going to behave and the level of risk they will take. Having better absorbency in terms of capital when it comes to Basel III, dealing with liquidity, thinking about restructuring the banking system, investment and other things. All this is quite useful, but I think unless we tackle in a very effective way the issue of incentive and the issue of compensation, it will be just a matter of time where those people who are in charge of this institution will find ways to circumvent any regulation, which is the nature of the relation between the regulator and the industry. And one question that came to my mind, why, for example, the FSB, despite the good progress or the good work in terms of the standard for compensation, why this was not part of this, let's say, Basel Committee or Basel Core Principles, which will make it quite more effective in terms of impact on different countries. We find this, for example, in our case, more relevant to us as a small country compared, for example, to the capital component of Basel III, because, and I think many emerging market or small countries, this issue of tier 2 and the loss of observance of capital is not quite relevant to these countries. So this is one area where it's a source of concern when we look at the development at that speed. The other thing, which is also a source of concern and might be even beyond the mandate of the FSB, but when we look at what's going on around us, part of the reform definitely is related to the financial sector, but we don't think it's going fast enough, and we don't think it's addressing the root cause of the financial crisis. A small country, the financial link might be quite limited to Europe or to the rest of the advanced economies, but at the end of the day, we will be impacted.
Exactly.
So,
what would you want?
And we would like, again, this might be again beyond the FSB mandate, but it's what we would like to see is sort of credible policies that end up this uncertainty that existed globally. And when we look back home, we look at this the cyclical capital buffer, and I think we start thinking about not only cyclical capital buffer for the business cycle, but also for the global financial cycle. And in our region, coming from the Middle East, maybe also we need to have a cyclical buffer for the transition, the political transition that takes place in our region, because at the end of the day, it would have economic consequences. I think the idea that came up from the global reform agenda is quite useful, and we try to build on it and think about other sort of risk and other cycle that might hit our region, including political and the global financial cycle that could arise in the future.
Thank you. Very interesting. Now the chair recognizes the gentleman from Turkey who has the real insider view. And Laurie, would you want to take your seat up here, please?
Madam Chair, I'm going to disappoint you. I don't have much experience. My experience is limited to the financial regulation discussion, the G20 meetings, but I follow this financial regulation issues. Let me try to assess where we are in terms of what we achieved in the aftermath of the recent global financial crisis. Well, as Michael explained very well, there was a very big financial crisis, global financial crisis, and we had to change. We had to almost, change entire global financial system, reform it. But let me assess where we are in terms of that. There are several areas that we try to reform the global financial system. The first area is the Basel III regulation. The work is done there. enormous and very successful work undertaken by FSB, G20, and other institutions. We recognize them. But there's a long way to achieve what we aimed at the beginning, because it level in the implementation. So we have a long way to go to achieve a successful implementation of Basel III regulation. That's the first thing. And then we have achieved really limited success with regard to regulating shadow banking system, data gaps, OTC derivatives, and CFIP framework. If you are going to put your confidence in the global financial system, you want to see decent progress along these areas. Otherwise, you are not going to put your trust in the global financial system.
Could you name those four again? The note taker was a little slow. Shadow banking,
data gaps, OTC derivatives, and CFIP framework.
Thank you.
Now, one area could be very important, very little progress. Accounting standards and credit rating agencies. We mechanically rely on credit rating agencies, which really function in a very pro-cyclical way. It doesn't really have the function of the global financial system. In this two areas, accounting standards and the credit rating agencies, very, very limited, almost no success at all. Well, there are other issues, governance structure of the FSB, we could say that. And then also, again, if you are going to put your trust in the global financial system, you need to have a really well-functioning international monetary system. Along the areas, there are works to be done, but that's our topic right now.
Oh, you can introduce it. You can introduce it. Come on, bring it in.
Well, that's related to the external stability, and it's related to surveillance. So, it's related, but it's not the job of the FSB financial regulation. I need to say also a couple of things about the policies of the advanced economies and that impact that on other countries, basically emerging market economies. We realized that at the end of the global financial crisis, advanced economies really have one option to use excessive monetary policy tools to stimulate their economies. No other policy instruments left for their use. But it has international implications. If it is fiscal policy, if it is macroeconomic policy, it doesn't have much international aspect. But if it is monetary policy, it has really strong international implication. Such monetary policies, excessive, loose monetary policies of international advanced economies, having an adverse impact on the emerging market economies, mainly in three areas: exchange rates, interest rate, and the funds available for credit. So it's going to disturb those three areas. You have your own equilibrium conditions, but it is going to be hugely disturbed by the advanced economy policies. Well, in the first place, dealing with the adverse impact of advanced economic policies on your economy, one thing, and the second thing, as the Governor of Sri Lanka mentioned very adequately, the impact of these policies when they are reversed. It's going to be really important. We should be well prepared for that. Well, there are a number of countries in the first place implementing such loose monetary policies. If they are all going to reverse their policies, that's going to be very synchronized, and the impact is going to be huge. So that should, the kind of sequential reversal is going to be the way forward. But who is going to coordinate it? And the countries will have, they will follow their own benefits, and it is very much likely that the reversal is going to be synchronized rather than sequential.
Are you sure you don't want to come and see Dan Tarullo today? He's a man who really likes the loose monetary policy.
I see.
I'm sorry, but I interrupt. Go ahead. Excuse me.
So I think we'd have to be very prepared for this. It's not FSB job perhaps, but it is the job of other international...
Whose job is it?
The G20 and IMF is going to be in charge of these policies. And I have other things to say, but I will save them for the next round.
Okay, thank you so much. And I'd like to introduce, this is so, thank you so much. It is such a learning experience. I don't know about the rest of the people in the room. I'm just soaking it in. It's absolutely wonderful to hear firsthand your experience, your perceptions, your agenda. And I'd like to take advantage of this moment to introduce our other panelists. This is Ms. Lori Wallach, who is with Public Citizen, has been a longtime campaigner for more just trade policies. And we have been working together on trade and financial services. And when the gentleman from Sri Lanka was speaking about the QE, quantitative easing bubbles, and how to cope with that, we have been thinking a lot about that from the perspective of some of the smaller countries, and the IMF's quasi-blessing of capital controls when there's a sudden inflow of capital, and then the difficulties in the trade arena that this situation presents. And with that, Lori, if you want to speak a bit about the work you've been doing on trade and financial services.
We call it now capital management.
Capital management. Oh, that's so much better. Pardon?
Capital flow management.
Capital flow management, yes. That's not threatening at all, is it?
No.
Capital flow management. Thank you. It's very benign.
And we call it now the North Atlantic crisis.
Okay. Lori, it's your turn.
Thank you. What Jo Marie asked me to address, and I apologize for coming late. There was a complication with my credential, so I've been running around trying to get in to see all of you for an hour and a half. I had a fine tour of this part of Washington, D.C. The issue that Jo Marie asked me to address was the consistency between the trend towards both international financial reform, countries' domestic re-regulation after the financial crisis, the FSB, versus the pre-existing obligations in various trade instruments, such as the General Agreements in Trade and Services, which covers financial services at the WTO, many existing bilateral investment treaties, BITs, as well as some free trade agreements, FTAs, and then also not just the existing, but those under negotiation, like the Trans-Pacific Partnership, which includes 11 Pacific Rim countries, including the U.S., New Zealand,
and soon the
Singapore.
Transatlantic Partnership.
And specifically, the rules, particularly in GATS and the FTAs, and that's speaking about the ones under negotiation, and why those include some of the same rules is a more interesting question. But the pre-existing rules were negotiated during the period where the conventional wisdom, the consensus, was that deregulation would increase investment, increase prosperity. The whole trend of deregulation was encompassed in these rules, and particularly with GATS, as many know, the U.S. and European financial services industries had an enormous role in setting those rules, and in fact have published several books bragging about it. So what is in those rules and in the FTA rules? Perhaps most dramatically with respect to the discussion of macroprudential regulation is very strict limits on government's ability to limit capital flows. There is a little bit more space in GATS relative to the FTAs. The U.S. FTAs basically have no space, no exceptions, not even for balance of payments crises. The GATS has a limited post facto exception on a general ban on limits of inflows or outflows for capital or current accounts. And in the GATS, the limit is for balance of payments crisis post facto. Once the horse is out of the barn, you can try and do something to clean up the mess. There is nothing to be done under those rules in an advanced state to try and avoid such a crisis. And there are also in the GATS and the FTA's financial services rules, that rule is also in the BITS, the ban on use of limits of capital flows. In the FTAs and the GATS are also market access rules that forbid even a non-discriminatory ban on a particular financial service or product. So a ban on regulatory bans. This is deemed under GATS jurisprudence as a zero quota forbidden market access restriction, even if it's non-discriminatory. And it is from this basis that, for instance, the German ban on naked short selling has been threatened by various industry interests as a violation of the EU GATS obligations. There are also limits with respect to regulations on size, legal forms. So right now the U.S. is getting an earful about some of its requirements of what kinds of forms certain foreign banks and securities firms must register and incorporate as, and as well firewalls. That latter set of issues around size, legal forms, and firewalls is more a matter of ambiguity. There is in the literature a big contest about what exactly those rules mean, but with respect to the ban on bans and the ban on capital controls, those are unambiguous, everyone agrees. And in the BITS and the FTAs, those rules are not only enforceable government to government, with trade sanctions to be put in place, for instance, if a country violates its GATS obligations, but in addition, in the other instruments, there's investor-state dispute resolution, which allows individual firms, the ones that the governments are trying to regulate, to privately enforce the rules as against the governments. Investor-state dispute resolution elevates the individual company or an investor to equal status with a sovereign nation to enforce privately a public treaty, and to demand compensation from government treasuries for any violation of that agreement. Cases are heard in tribunals of 3 private sector trade attorneys who rotate between being the judges and suing governments. What would be an astonishing conflict of interest in most of our domestic legal systems. And they operate under the rules either ICSID at the World Bank or UNCITRAL at the UN. There is no outside appeal to these decisions. That is the context of the existing rules in our trade agreements. Then the conflict. The IMF's recent institutional view in support of sometimes using capital controls as macroprudential instruments. One can see very easily the conflict that can occur, where you might, as a country, have the IMF instructing you in advance of an asset bubble they see as starting to start limiting inflows, for instance. Certainly the least disruptive version of macroprudential regulation, yet inflows with advance notice. Yes, a country with an FTA, a BIT, or under their GATS obligations would be in violation of their trade obligations were they to follow that advice from the IMF or very likely from their own central bank, which would probably catch it before the IMF, hopefully, usually, in many countries, truly. This is also a problem of chilling countries taking action in addition to the institutional conflict issue. And a very sad point is Singapore, one of our countries and your country's partners in the TPP, which saw another asset bubble emerging in real estate, decided to take action in advance, decided the way to do that was to put a 15%, there are a variety of things they did domestically to try and slow things down in that sector, and they put a 15% tax on inflows, foreign inflows, for investment in the real estate sector. 15% tax on foreign investment in real estate. Except they had to take an exception for any U.S. entity. That's opening a door for any investor to incorporate a U.S. entity to make that investment, because as a signatory to the U.S.-Singapore Free Trade Agreement, they are forbidden from having any limit, be it a capital control, a tax that is discriminatory on foreign inflows. So they have lost the tool to be able to deal with what is, from their central bank's perspective, a very serious, foreseeable future problem that they would like to avoid having to clean up after. And this is not hypothetical. You pull up their register of laws and regulations, they explain explicitly, we have done this act, we cannot do this because of the FTA with respect to this set of capital. It's a concern.
Laurie, I'm going to interrupt you 1 second because I know that our gentleman from New Zealand has to exit in about 4 minutes. So is there anything further you want to ask, say, question?
I have actually only one more sentence.
Oh, sorry, Laurie. Go ahead.
I have materials that go through how many countries are bound in GATS, which is 26 fully, 22 to some degree, another 40 developing countries, to a more limited degree with respect to these capital control limits. And I also have, as an example of the threats and the chilling, because I'm using the U.S. as the example, our Chamber of Commerce threatening that the Volcker rule is a violation of NAFTA and listing the companies in Canada that might take action against it as a matter of illegal financial regulation under our current trade agreement obligations. So I'll just hand these.
Great. Thank you. Thank you. That's excellent. Mr. Spencer.
I mean, just to comment on that, I mean, I agree it is a real issue. And the IMF is saying that QE for Europe, Japan, England, and Britain and the US is good for those economies and good for the global economy. And you can debate that at the end of the day they're making an assessment that flooding their system with liquidity is going to help maintain growth in a difficult situation with still debt overhangs, etc. But it has huge implications for smaller countries, and in particular countries that still have a reasonable growth performance. So, for example, when Mr. Kuroda announced the new initiatives in Japan about a couple of weeks ago, immediately there was an impact on dollar-yen, obviously. Dollar-yen dropped. But our currency, the New Zealand dollar, increased by over a cent, about 1.5 cents, to reach a new record level. So, seemingly unrelated things, but that money, that liquidity coming from Japan and of course from the other three countries is definitely seeking out returns in the rest of the world in countries where there's reasonable growth with reasonable interest, more normal interest rates. And it's a very difficult thing to manage domestically from a small country's point of view. Now, the IMF says, okay, so given the situation in the major economies, small countries are now allowed, they now have permission to manage capital, to implement the macro-prudential. And we ourselves are developing a macro-prudential framework which avoids capital controls. We think that's really off the agenda. It's more like a last resort. But we are developing a macro-prudential regime which is about using prudential tools to provide overlays in the upcycle to try and affect the supply of credit without recourse to just cranking up interest rates. Particularly as we do have an emerging housing issue. So that macro-prudential policy will help, and it's good that the IMF is sort of supporting that and maybe potentially giving advice on it. But it's really only going to work at the margin. At the end of the day, it's very difficult to stop these major capital inflows coming from the likes of Japan and the US. So it's a very difficult problem, but it's introducing major distortions into countries such as our own. And I would definitely, regard capital controls as a last resort, and certainly supported by these various trade rules that, actually will say that such capital controls are inappropriate.
Can I ask a question? Having just been down in New Zealand and talking to a variety of the small business and manufacturing sector there, I know they're very keen actually for the government to consider something like, for instance, Brazil has used on inflows in the form of capital controls to avoid all of this flood of money, given that you have certainly the capacity to do that. Is it just because of the prohibition and the trade rules that you're not using that tool that so many other countries are using on inflows?
So New Zealand is a debtor country. We have external debt. And so we're not a very strong saving country. We tend to dissave. So we're relying on foreign savings. So it's very dangerous for us to say, okay, let's introduce capital control, because it's a bit like, be careful what you wish for, because that would increase the cost of capital for the country and potentially have quite restrictive effects on the domestic economy, because we are reliant on foreign borrowing. As a country, we spend more than we earn. And so I guess if you're in a country that is a net saving country, for example, many of the Asian countries, then you may feel on safer ground with capital controls. Indeed, you see capital controls more in those countries.
Let me ask you sorry to interrupt, but I know you're going to run. Would this be the kind of issue the FSB should take up, or is it going to be adequately handled as the gentleman from Turkey suggested in the G20 and the IMF? What's your...
Well, I think it is the latter, you're right. It's not really an FSB issue. I mean, I'm not sure how you define an FSB issue, but to me it seems to be you have Basel, which is the rump of capital adequacy, liquidity requirements, etc., and then FSB is picking up a range of financial stability issues sort of around that, such as compensation, Gs and Bs, etc. But I think FSB that we should rightly stay with in the financial stability area. Getting into the issue of global liquidity really is international macro monetary policy, which is the realm of the IMF in particular.
Okay, thank you. Thank you. And we're sorry to have you leave, but we respect your schedule. Now, I'd like to give the panelists an opportunity to interact, and then we'll open up to questions from the audience. So, Michael, did you want to comment?
Yeah, I just wanted to come back on a couple of the points that have been raised in the discussion. I think the point that's just been made about some of these issues are not really FSB issues is a very important one, because our role as I talked a lot about process in my introductory remarks. I didn't really talk very much about the substance of, and that's a sort of occupational hazard, I think, because we do tend to talk quite a lot about process in the FSB. But the substance of what we're doing is in response to the crisis, and is an agenda which is set for us by the G20. Now, that agenda is inevitably somewhat limited in the sense that we're not looking at issues like capital controls, we're not looking at issues like cross-border capital flows, we're not looking at the coordination of monetary policy, because those issues have been, or there are fora which are already there where those issues can be debated. The IMF the G20. As far as trade issues are concerned, there's the WTO. What we're doing is to fill a gap, a perceived gap in the global framework. And that perceived gap primarily relates to the way in which the standard setting process is coordinated. What drives it, what the issues that the standard setting bodies respond to, and how those different parts of it fit together. And that's primarily where we fit in terms of this overall framework. So we don't have a huge mission which covers the entire financial system, or every issue which could be potentially a financial issue. What we have is a set of issues which we're dealing with, many of which relate to the too big to fail problem, and maybe we can talk about that in a moment. But it is a very well-defined mandate, and it would not be, I think, either sensible or particularly helpful for us then to start to move away from our core mandate into other kinds of issues.
Okay, thank you, Michael. Other comments? Thank you so much.
Sure. Well, we know that in the long run, the reform package introduced by the FSB and the G20 will enable us to achieve what's called in G20 terminology strong, balanced, and sustainable growth. But the transition is very important, and an orderly transition without much adverse impact is the part that we need to focus on. Well, the regulation has some adverse impact in this transition period. But there are some vulnerable areas for the impact of regulation in the area of project finance, in the area of trade finance, in the area of asymmetric treatment of countries by the international banks. We don't know the extent of the impact of adverse impact of the current financial regulation. To what extent, for example, the performance of the last year, for example, world trade volume increase, which was just mere 2%, which is one of the worst performance of the world trade volume, down to this adverse impact of regulation coming through its impact on trade finance. Similarly, investment is declining all over the world, whether it's related to the impact of regulation on project finance or not. And also there are vulnerable parties in this context, the small countries, which are really differentiated by the regulatory authorities. We know that the international banks need to deleverage, but the question is whether this deleveraging is going to be orderly or not. But we see that this is not orderly. It has strong international impacts. We need to deal with this sort of issues. Again, this may not be FSB issue, but I think in this regard, probably FSB can do more in terms of getting consistent treatment of, consistent implementation of financial regulation. Because this issue, the deleveraging issue, is very important. The disorderly deleveraging issue is very important. So it will take time that the international banks or globally important banks to delever. But we need to manage the adverse impact of these deleveraging effects.
And how would you do that?
Well, there are some initiatives to elevate the impact of adverse impact of deleveraging on small countries. One of them is the Vienna Initiative, certain parties put together $30 billion US to help the adversely affected countries such as Albania, in general, Macedonia, in general, Central and Eastern European countries. I'm sure that applies to the other countries, but that area really is very unique because the banking system is really internationalized. The share of local banking system is not there really. So this sort of international initiatives would elevate the problem, and also, a careful implementation of financial regulation should be looked into.
Okay. Yes, sir. You've waited patiently.
Thank you. Just 3 quick comments that I have. One is about the areas of interest that whether or not it should be included in the agenda of the Financial Stability Board. I think the civil society groups will have some latitude to offer suggestions, and whether it is coming within the purview of the FSB or not would be a matter that they should really be grappling with. But I think if there is any issue that has an impact on financial stability, it needs to be recognized by the FSB. The second point is the point that was made by the Deputy Governor of Turkey, which is very important. The role of the accounting standards and the credit rating agencies. I think these also are essential if we are to maintain financial system stability on a long-term basis, and some way which these could also find itself into the agendas, so that there is some global norms setting out would be very useful. The third point is about net savers and net spenders. Depending on which type of country you are, you may welcome new inflows or may not be all that happy about inflows coming in. So that's a matter that the different countries will probably have to work out by themselves. But I think globally we will need to have some kind of a response to it, and there will be instances where different countries could look at these issues from a country perspective, and that's something that we will need to respect, because each country will firstly be interested in financial system stability as far as their own countries are concerned, and then they will extend it to the rest of the world. But we also recognize that if the rest of the world is not having stability, then it's very, very difficult for a single country to have stability as well. But yet the tendency would be for countries to immediately look at your own situation, and that is why we have all these new policies that are coming in with QEs and all these other areas, which are essentially designed to ensure that your own economy is supported, even at the risk of some other economies being threatened.
That's fine. That's fine. Thank you. You have the last word in this round, and then we're going to open it up to questions.
Quite brief, I think from our side, FSB member, G20 member, but small countries, there are areas of the reform that are quite relevant and useful for us, and then the other part is a concern about the spillover from expansionary monetary stance in many advanced economies, and also the point that was raised by the governor of Turkey about the deleveraging. I would put it even more generally, which is part of the spillover to these countries. Some banks, some international bank to reach the new capital requirement has to deleverage. And sometimes part of the deleveraging process would be selling subsidiaries or exiting specific markets. Now, in the case of deleveraging by lowering the extension of credit or shrinking the risk-weighted assets, you will be in a different business cycle, and you would expect the financial system to use the saving to help with the growth, but the agenda of the global international bank might be a little bit different. Now, in the case of deleveraging or in the case of resolution, And this might not be quite relevant to our region, but having worked with the IMF for 7 years in European countries, I know that it's a concern, which is what sometimes we call it an orphan bank, an international bank deciding to exit a specific market by selling the assets or selling the subsidiary. And then the supervisor authority is facing the question to whom we can sell this bank. There's no fit and proper potential buyer at the current global environment, and then they might have to deal with second best solution in such circumstances. So it's again, this spillover concern is something that is quite important to many countries, and we hope that these views or concern could be reflected in a way to minimize even spillover in the rest of the countries.
Would you see the RCG, the Regional Consultative Group, as a place to discuss and seek an implementation?
Definitely it would be an important challenge.
Okay, great. Laura, you wanted to come in on these issues?
I would throw out, listening to the government's representatives and the agency representatives, just one thing as a heads up, which is with respect to accounting, which is very important. There's an orphan leftover accounting agreement lurking about the WTO that has been accepted by all the members but never adopted. It is 10 years old. That is sneaking up for potential adoption at the Bali WTO ministerial. That it might be worth some of the regulatory officials in the countries to mention to their trade officials that the thing should be put to a graceful death and buried, as it comes from a period where Arthur Anderson was sitting at the table helping to write it, and it is constraints on accountancy regulation, including a requirement that every accountancy regulation have the least trade restrictive effect as compared to the most robust stability effect, which is to say the criteria for domestic review of any domestic or international accountancy standard, including those that are being formulated in the context of different international processes, would set a conflict with these existing, and not yet existing, but ready to be adopted, agreed set of WTO disciplines. The agreement's called the Agreement on Disciplines of Accountancy Regulation. And so heads up of that lurking potential conflict, not yet created and therefore fixable easily. The other issue is just on perceived gaps. I think it's an open question what should be the role of the FSB, but with respect to the notion of having the trade agreements regulate any of these areas, given the goal of the trade agreements is to reduce regulation in the name of facilitating investment and trade flows, it's certainly not a balanced perspective. So while certainly they have invaded that territory with trade rules, and it covers everything. It covers not just flows of trade and services across borders, but the ability of countries to regulate a foreign investor in those services in their country. And the rules are not particularly favorable for having regulation, as I explained. Some non-discriminatory forms of regulation are simply banned. There is a prudential exception. The problem is it has a second sentence that many have interpreted to be self-canceling. It says governments can take actions that would otherwise violate these rules for the name of stability, except, second sentence, they may not do this if it undermines their obligations of the agreement. But of course, we'd only ever need to use the exception if a measure you had taken was being threatened as a violation and therefore you had to defend it, at which point you would not be able to use the exception. So just flagging that.
Okay. Now, I'm going to do a round of, say, 3 questions, and then, okay, 1, 2, and 3.
Yes, I'm Per Kurowski. If a certified financial advisor was offering the same advice to a wealthy retiree pensioner that to a poor young professional, he would have his certification immediately revoked. Yet the Basel Committee does just that when expecting banks in the developed and developing countries to basically act the same way. Basel II, Basel III, by favoring the infallible over the risky, is designed for the wealthy and the retirees and works against the interests of the young and the poor. Much of the world cannot afford any longer having a financial stability board when what it most needs is a financial functionability board.
Okay, thank you. Number 2.
Yes, in fact, it's not a question, it's more a comment. And I would like to complement what the Deputy Governor from Turkey said. Actually, the FSB is paying increasing attention to the consequences of the regulatory reforms on emerging markets. And there is a specific work stream dedicated to this issue. And in 2012, the FSB published an important report which analyzes the consequences, the unintended consequences of the regulatory reforms on emerging markets and developing economies. And one of the outcomes of this important survey is that participants, members of the FSB, say that they don't expect major consequences of these reforms on their economies, but there are certain areas that deserve more attention. For example, the implication of Basel III, or the potential implication of Basel III on trade finance, SME finance, long-term finance, and so on and so forth.
Okay, thank you.
So it's really important to have this in mind.
Thank you. Number 3.
Good morning, ladies and gentlemen. My name is Rosemary Segero. I'm president of Hope for Tomorrow. Thank you so much for your wonderful presentation. I wanted to ask a question and a comment. How do you look at the African financial regulatory, especially when it comes to, as the governor for Sri Lanka said, the Africa is full of resources, minerals of all kinds, which is also part of the financial institution. How do you rate, or how can you say or recommend how they can use, or how the part of the minerals and the financial system can be? As you see, it's full of resources, but the way they manage it, it's not really through trade or just,
okay.
You know. Thank you.
Great, thank you. Okay, quick response, please.
Yeah, I'd like to, thank you. Sorry, I didn't catch your name.
Pierre Chatin.
Yeah, thank you for bringing up the question of the emerging markets. Because we have, as you say, conducted a number of studies looking at the impact of the reforms on the emerging and developing economies. So it isn't as if it's something that we haven't looked at. It's not something that we're not aware of. And I think one of the points which I think it is very important to stress, and I think this comes to the gentleman's point over here, that pre-crisis, the emerging economies had effectively no voice in the international standard setting process, the Basel process. I spent 10 years working in the emerging economies pre-crisis. And some of them had very significant financial systems, but we had no ability to shape the global standards, the international standards. Post-crisis, the FSB, the Basel Committee, have expanded their membership to include many significant emerging market economies. And so they have a seat at the table for the very first time in this whole process. And that is a crucial change which should not be underestimated in terms of its importance, because the emerging economies have now been given a voice which they never had before in the standard setting process. Now let me just come to the point about we're adopting a one-size-fits-all approach. I think it's very important to be clear on a couple of points. The first one is that the international standards are ones that are set by the standard-setting bodies to apply to their own members. They become international best practice, and therefore many other countries which are not members emulate them and adopt them. But there is no requirement in international law or treaty that they do so. It is simply that they become established international best practice. From the point of view of something like Basel III, I think it's very important to point out that for many emerging economies, yes, there are elements to Basel III which are too complex. And I think anyone who's involved in that would acknowledge it. In that case, don't implement that part of the complexity. But the crucial part of Basel III, which is raising the capital that banks are required to have to back their assets, that is something which no emerging market economy should have any difficulty in meeting. Because basically, what Basel III is saying is that banks need to fund a larger proportion of their assets than they did in the past through equity and reserves, common equity. Now that makes sense from a financial stability point of view. It certainly makes sense in an emerging markets context where you have a much more volatile economic environment. And so you would expect there to be proportionately greater losses on any given loan portfolio. And it also makes sense because in many emerging market economies, bank capital has in the past primarily been formed of equity reserves. There hasn't been the same kind of financial engineering as went on in the so-called advanced economies pre-crisis, which resulted in many banks in the North Atlantic region having a capital base which was far too thin because it wasn't able to absorb losses on a going concern basis. Now, none of that I see as being inconsistent with having a development agenda for the emerging market economies. Where the global reform agenda starts to bite is in the deleveraging, that's been pointed out by several fellow speakers. Now, there are some regions of the world which are more affected by this than others. And I think it's significant, for example, that in the MENA region, the European banks have played a much larger role in terms of providing credit than they have in some other regions. So retrenchment by the European banks obviously has an impact in terms of a region which in the past has been quite dependent on credit provided by European banks. Is it necessarily the case that banks need to delever? No, it's not, because the alternative is to raise more capital. But that goes to the heart of the way in which these issues are being handled by domestic regulators. Do you tell a bank to go out, raise more capital, have more retained earnings, or do you allow them to shrink their balance sheet? Because there are two ways in which you can go about meeting the ratio. That is an issue for the domestic regulators. But what we can do as a global forum, as an international forum, is provide an opportunity for those countries which are being affected by this process to raise it with their counterparts, the home country regulators, and to say, do you realize what kind of impact this is having? So I think that's a very important role that we can play. Just very quickly, 2 points. Accounting standards, yes, we're trying to get some kind of convergence on accounting standards. It's very difficult because we're dealing basically with the US accounting standards set as FSB and the International Financial Standards Board, FSB. Trying to bring them two together to agree a set of common standards is not easy. It's something which we've been working on for several years now, and we continue to work on. Credit rating agencies. There are a set of FSB principles on credit rating agencies that were published in October 2010. We currently have a peer review going on, which will be completed towards the end of this year, which will set out the progress that has been made or where more effort is needed to implement those principles. So again, this is something we're trying to push forward. There is certainly more that we can do on both of these topics, but they are topics that the FSB is dealing with.
Okay, I'm very mindful of people's schedules and times. While we have the room until 10:45, I believe most people are hanging on until 10:30, and then they have to blast out of here. I would like to ask the FSB a couple of things. One is, would there be a place on your website where people could ask questions? Because I'm sure the questions that people are raising are not unique to that individual, but to have a question spot on your website and you could give a response. Okay? Number two, I would love very much to, I am going to compliment the Financial Stability Board. Okay? Let the record show I have something constructive and positive to say. It's very encouraging that several times the FSB has asked for public input before a regulation is finalized. I think you are to be congratulated. Congratulate your bosses. Congratulations to you. This is very important. The IMF is not yet where you are. You are ahead of the IMF. So in the race for legitimacy and transparency, you're way ahead of the IMF at this spot. So I really want to congratulate and encourage that, and encourage people to track the website financialstabilityboard.org. And I think the issue of not needing to comply with all regulations is very important. This is something we have heard of great frustration from African regulators who are not present in this room, but we've consulted with them otherwise. They say our banks implement Basel III before anybody else, and it's not meant for them. So with that, is there any final comment from our presenters? Lori,
can I say
Dr. Hassan, yes.
One thing
Dr.
regarding
Kim.
this, regarding the financial regulation and its impact on emerging market economies. Not only emerging market economies, also it's an effect on other countries too. As I mentioned earlier on, transitional impact of financial regulation and ongoing deleveraging. But on top of that, we have another thing, what is called ring fencing rules. There is one rule, Likanen report, for the European countries, another one for the United Kingdom, Vickers rule, called report, sorry, and the Walker rule for the United States. These ring fencing rules have strong implications for not only emerging market economies, but also other advanced economies. Basically, when they are trying to re-fence commercial business of the banking sector from the investment business of the banking sector, somehow there is ring fencing related to countries. So that aspect is also an important issue that we need to
I did not know about that. Thank you for raising that. Okay. Sir Michael, I have for you the first two questions for your public website. That's from one of my board members. Out of respect for you present, I'm not asking his questions. With that, I would very much like to thank all of you for attending. I think we've begun an important conversation. I can't wait to have the agenda and the notes, the agreements from the regional consultative groups posted on the website. I want to know how you choose members and who gets in and who gets out, and what the non-members can do about it. Yes. Thank you so very, very much.